Most people spend decades imagining what retirement will feel like. The slower mornings, the freedom, maybe a trip you've been postponing for years, or simply the relief of not setting an alarm. You've earned that. You've worked for it. And for most of your life, the financial side of things ran on a kind of autopilot. Your employer withheld taxes, sent your W-2, and April came and went without much drama. But something quietly shifts the moment you cross into that final year before retirement. And it's not the shift most people are prepared for. Because here's what nobody tells you at the retirement party. The IRS doesn't see your retirement the way you do. To them, this transition isn't a milestone. It's a financial event. One that triggers a specific set of rules, deadlines, and obligations that millions of Americans walk into completely unaware. Not because they're careless, because they simply didn't know to look. Think about someone who retires in March, starts drawing Social Security in June, takes a small distribution from their IRA in August to cover a home repair, and by December, genuinely believes they've had a straightforward year financially. Then tax season arrives, and suddenly there are penalties they didn't expect, a tax bill that feels inexplicable. Withholding that was never set up correctly, deadlines that quietly passed months ago. That feeling, that combination of confusion and frustration, is more common than most financial channels will ever admit. If you're planning to retire in the next 12 months, the IRS already has a framework in place for people in exactly your position. 6 specific things they expect you to address before, during, or shortly after that transition. Most retirees never hear about them until it's too late to avoid the consequences. There's a reason this conversation is happening more urgently right now than it was even 5 years ago. The retirement landscape has changed in ways that make the tax side of leaving work significantly more complicated than it used to be. A generation ago, most Americans retired with a pension, a fixed monthly check, taxes already calculated, nothing much to manage. The system handled it. But that world is largely gone now. Today's retirees are managing a combination of income sources, 401k distributions, IRAs, Social Security, part-time work, investment accounts, maybe rental income, and each one of those streams carries its own tax treatment, its own timing rules, and its own set of IRS expectations. What makes this particularly difficult is that none of these sources automatically coordinate with each other. Your 401k custodian doesn't talk to Social Security. Social Security doesn't talk to your brokerage, and none of them are calculating your total tax picture for the year. That job falls entirely on you, often for the first time in your adult life, right at the moment when you're also navigating Medicare enrollment, adjusting your budget, and emotionally processing one of the biggest life changes you'll ever experience. The IRS, meanwhile, is operating on the assumption that you know the rules, and this is where the gap becomes dangerous, because the penalties for underwithholding, missing required distributions, or misreporting retirement income aren't symbolic. They are real dollar amounts, sometimes thousands, attached to decisions people made without realizing they were making decisions at all. What's changed recently has also added pressure. Adjustments to Social Security taxation thresholds, updated RMD ages under recent legislation, and shifting rules around inherited accounts have all moved quietly in the background. Many retirees are still operating on information that's 5 or 10 years out of date. The rules have moved, and the stakes of not knowing that are higher than most people realize until they're already sitting across from a tax professional in February, wondering what happened. Here's where it gets personal and uncomfortable, and for a lot of people, surprisingly emotional. The hidden problem isn't really about taxes, not at the core. It's about the fact that retirement removes the financial safety net most Americans never realized they were standing on. When you were working, your employer was quietly doing something incredibly important on your behalf. Every single paycheck, they were calculating what you owed the federal government, withholding it, and sending it in, quarterly, without you lifting a finger. You never had to think about estimated payments. You never had to track your withholding rate. The system absorbed all of that complexity invisibly. The moment you retire, that invisible system disappears completely. And in its place, you're suddenly responsible for something you've genuinely never had to manage before. proactively paying taxes on income that arrives without any withholding attached to it. IRA distributions, investment gains, even Social Security for many people is partially taxable. But none of it comes with automatic tax removed unless you specifically set that up yourself. Most people don't, not in that first year, because nobody told them they needed to. Take a realistic situation. A woman retires in the spring after 32 years in healthcare administration. She's careful with money. She's done everything right. She begins drawing from her IRA, modest amounts, nothing extravagant, to bridge the gap before Social Security kicks in. She assumes the 1099 she'll receive in January covers everything she needs to know. What she doesn't realize is that without setting up voluntary withholding or making estimated quarterly payments, she's been accumulating a tax liability all year with nothing to offset it. By the time her accountant walks her through the numbers, she owes more than $4,000, plus an underpayment penalty on income she spent months ago. The money is gone, the bill is real, and the penalty feels deeply unfair for someone who wasn't trying to avoid anything. That's the emotional weight of this issue that gets lost in every standard finance article. It's not negligence. It's a system that stops protecting you the moment you stop working and doesn't bother to announce its own departure. And the withholding gap is only one piece of what the IRS expects you to manage. The retirees who navigate this transition without financial damage aren't necessarily wealthier or more sophisticated. They're simply more deliberate. They treat that final year before retirement as its own distinct financial season, one that requires a different kind of attention than any year that came before it. The first thing they do is sit down with a tax professional, not in January, not after they've already retired, but 6 to 12 months before their last day of work. That timing matters enormously, because there are decisions made in that window that simply cannot be undone once the year closes. Roth conversion opportunities, strategic timing of final salary income, the question of whether to delay or accelerate certain distributions. All of it requires visibility into the full picture before the picture is already set. They also set up voluntary withholding on every income source that allows it. Most people don't realize that Social Security allows you to request federal tax withholding directly at 7%, 10%, 12%, or 22%. IRA custodians will withhold taxes from distributions if you ask them to. Setting this up doesn't cost you anything. It simply ensures that when April arrives, you're not facing a bill built entirely from money you've already spent. It recreates, imperfectly but meaningfully, the automatic safety net your paycheck used to provide. Smart retirees also take required minimum distributions seriously and early. If you're turning 73 this year, or you're already past that threshold, the IRS requires you to withdraw a minimum amount from your traditional retirement accounts annually. Missing that deadline doesn't generate a gentle reminder. It generates a penalty of up to 25% of the amount you failed to withdraw. That's not a technicality. That's a significant financial consequence attached to a calendar date. What separates the people who handle this well from those who don't is rarely knowledge alone. It's the willingness to treat the transition itself as something worth preparing for, financially, not just emotionally. There's also a quieter habit worth noting. The retirees who feel most secure in those first years aren't the ones who simply reacted to each tax surprise as it came. They built a simple, repeatable system, estimated payments on a quarterly schedule, withholding set up across accounts, a rough annual tax projection reviewed each fall. Nothing complicated, just consistent attention applied at the right moments. That consistency is the difference between a retirement that feels like freedom and one that feels like it's constantly catching you off guard. Even people who do most things right can get tripped up by a handful of specific mistakes that don't announce themselves until the damage is already done. These aren't obscure technicalities, they're patterns that show up repeatedly. In accountants' offices, in tax notices, in conversations people wish they'd had a year earlier. The first is assuming that a lower income automatically means a lower tax rate. Retirement often feels like stepping into a simpler financial life. Less coming in, so surely less owed. But the reality is more complicated. When Social Security, IRA distributions, pension income, and investment gains combine in a single tax year, they can push a retiree into a bracket that surprises them and simultaneously trigger what's known as IRMAA, the income-related adjustment that increases Medicare Part B and Part D premiums. A single large IRA withdrawal, taken without planning, can cost someone thousands in unexpected Medicare surcharges the following year. The income and the consequence don't even land in the same calendar year, which makes the connection almost impossible to see without guidance. The second mistake is treating the first year of retirement as a grace period. There is no grace period. The IRS applies the same underpayment rules to retirees in year one as they do to anyone else. If you don't withhold enough or make estimated payments by the quarterly deadlines, April, June, September, January, you will owe a penalty. The fact that you are new to managing your own taxes is not a mitigating factor. The third is neglecting to update beneficiary designations during this transition. This one carries consequences that extend beyond your own financial life. Retirement accounts pass outside of a will entirely. Whatever name is listed on that beneficiary form is where the money goes, regardless of what any legal document says. People who divorced years ago, remarried, or simply never updated paperwork after a major life change have inadvertently left significant assets to the wrong person. It happens with painful regularity. The fourth mistake is underestimating state taxes. Federal taxes get most of the attention. But depending on where you live, your state may tax pension income, IRA distributions, or Social Security in ways that add meaningfully to your annual bill. Some states are genuinely retirement-friendly, others are not, and people who relocate in retirement without researching the tax environment of their new state sometimes discover the difference too late to adjust. Each of these mistakes shares a common thread. They're not caused by recklessness. They're caused by the quiet assumption that retirement, once reached, runs itself. It doesn't, at least not in that critical first year. There's something worth saying quietly before we close. You didn't spend 30, 40, sometimes 50 years working, budgeting carefully, raising a family, making sacrifices most people never fully see, just to hand a significant portion of your retirement security back to the IRS through penalties and oversights that could have been avoided with the right information at the right time. That's not dramatic. That's just true. The financial system is not designed to walk you through this transition. Your employer's HR department hands you a packet and wishes you well. Social Security sends you a card, Medicare sends you a booklet, and somewhere in between all of that, the IRS quietly expects you to have already figured out the rest. No announcement, no checklist in the mail, just the assumption that you know. Now you know more than most people do when they reach this moment. You know that voluntary withholding needs to be set up. It won't happen automatically. You know that required minimum distributions carry real penalties if missed. You know that a single poorly timed withdrawal can affect your Medicare premiums a full year later. You know that beneficiary forms carry legal weight that no will can override. And you know that the single most valuable financial conversation you can have right now is the one you schedule before your retirement date, not after. That knowledge has real dollar value. More importantly, it has peace of mind value. And at this stage of life, peace of mind isn't a luxury. It's the whole point. Retirement should feel like arriving somewhere you've been moving toward for a long time. Not like navigating a minefield you didn't know existed. If this gave you something to think about, something you hadn't considered before, share it with someone who's approaching this same transition, a spouse, a sibling, a friend who's been talking about retiring soon. This is exactly the kind of information that tends to reach people a year too late. And if you want to keep building this kind of clarity around your retirement finances, subscribe and stay close. Every video here is written with the same intention, to give you the honest, grounded information you actually need without the noise. You've earned a retirement that works for you. Make sure the IRS doesn't quietly take more of it than it's owed.